morning or good afternoon, everyone. Thank you again for taking the time. Yes, thank you again for taking the time. The topic that Ramon and I are going to discuss today are some estate and succession planning ideas, planning strategies, implications, those sorts of things, and why we think it's really important to your overall business strategy and your business in general. So we really do appreciate everyone taking the time to spend the next hour or so with us. My name is Derek Dockendorf. I'm a senior manager in our Minneapolis office, and I work with Ramona Johnson, who is a partner in our Fargo office, and we are members of Eide Bailly's Wealth and Transition Services team, and Ramona is one of the co-directors of that group. So in our time today, we're hoping to cover three areas. One, what's the current state of owner readiness as far as when it comes to transitioning or exiting out of their business? Two, what are the components of an exit or succession plan? And you'll hear those two words, exit and succession plan, kind of used interchangeably. But that second topic there, what are the components that we view to be important to be a part of that overall exit and succession plan? And then the third item there is Ramona's going to come in and talk about the current estate tax environment, some planning ideas, and some thoughts around how we can tie your estate plan and the strategies that you're trying to accomplish in with your overall business succession plan. So let's go ahead and kind of hop in here and look at what are owners currently ready to exit their business. And over the next couple slides, I'm going to show you some various graphs, and these all came from the Exit Planning Institute. It is a national organization that helps a lot of advisors with business owners work through that exit planning process. And they do these, what they call state of owner readiness reports. And they kind of do it for pockets throughout the country. And this one happens to be based on the Twin Cities metro area from 2017. So this first one here that I'd like to bring up are of the business owners that took this survey and responded back, what are their current ages? And as you can see here, that over 80% of the respondents are at least the age of 50 or older. We've got some that are, 70 plus, that's 12%. Roughly a third of the business owners that were surveyed in this report that they sent out were between the ages of 60 and 69. So you can see that a lot of the owners that are there are probably at that stage where they're starting to think about, what do I want to do when I want to transition out of my business? Who do I want to transition it down to? What's my time frame? Those sorts of things. I really like this next slide because when we talk to clients about exit or succession planning, they often think that it's just for the overall really big companies. But I think this slide really pinpoints the importance of how it impacts everybody. If you look at this, what's the annual revenue from a company standpoint? About 83% of those that were surveyed had revenue of $25 million or less. Over half of the respondents had revenue of less than $5 million. And I think that's where a lot of value can really be added when you're in those less than 5 million to 25 million in revenue, where if we take the time, go through the steps, go through the process, we can really help to position you as the owner through that transition, that you're going to be satisfied at the end of the day, and really help position your business, whoever you're transitioning it down to, so it's going to be a successful transition in their eyes as well. So again, I feel like a lot of folks think that, this exit or succession planning really is for the big companies. It notes they're $100 million or more in revenue, because that's the big mergers and acquisition space. And there's a lot of activity that's there, but there's a lot of owners that have those small business owners that we can help bring a lot of value through this overall process. The next slide here is, the question is having a transition strategy important? And as you can see, over 90% either agreed or strongly agreed with this statement. But what's interesting is, even though we had such a high agreement in that having a transition plan is important, 94% of those that were in this survey had no written personal plan at all. Roughly half hadn't done any business planning, and about 80% had no written business transition plan in place. They may have thought about what they want to do, but they had nothing formally written down as far as what those steps would look like and what would happen at the end of the day if something were to happen to them in the interim. So even though a lot of them agree that this is a very important topic and something that they should be spending time on, a lot of them haven't taken the time to work on this strategy and put some of these pieces in place. This one was also interesting. Are they ready to exit? So if you kind of go back and think about that first slide where we talked about the age of the owner, we had roughly 80% that were over the age of 50. And if you look at this slide, are they ready to exit, or when do they want to exit is the question. Over 50% plan to be out of their business in the next 5 years. If we throw in the next 10 years, we're almost 75%, actually 77% of the business owners want to exit the business in the next 10 years. So you can see the urgency behind some of the owners are ready to transition, and they agree that having this strategy is important, but a lot of them haven't really taken the time to kind of put the pen to paper, think about the options. What do they want to do at the end of the day to really make this transition as successful as it possibly can be? I thought this one was very important too. Do I need my business to remain profitable after they exit? And you can see there that 60% agreed yes. It's either critically important or it would be helpful if the company remained profitable after they transition ownership for this overall transaction or this transition to be successful. And when I look at this result from the survey, in my mind, what I think about is they're probably doing a transaction with, down to their children or key employee or somebody that was already inside of the business. And for that owner who's exiting to really get the value out of their business that they want at the end of the day, they're probably getting some of the cash flow from those new owners to pay them out over a period of time. So that's why they still need that business to remain profitable after they've transferred their ownership to really make this as successful as it possibly can be. And one of the stats that I don't have up there, and it's in the report, and you can go out on the Exit Planning Institute's website and find these reports, but the owners that they surveyed, roughly 80 to 90% of their net worth is tied up into their business. So you can see the importance of, that's for a lot of these owners, their business is their, entire net worth. They may not have a large 401k or an IRA or a brokerage account to fall back on in retirement. Being able to maximize this value for their business is going to help set them up for the retirement that they're hopefully going to have into the future. So on to the components that we feel like are part of an exit or succession plan. Now we've got 7 items here that we'll kind of go through in the next handful of slides and everything. We have them listed here in a specific order, but really we don't always follow 1 through 7. There may be some other items that are very important to those owners that we want to tackle first and foremost before doing some of these other items. Business continuity planning. What if something happens to a key employee or the owner itself? How is that business going to continue on? That may be something that we want to tackle first. Maybe something that like Ramona's going to talk about later with the estate planning. Maybe there's some holes there in their estate planning documents that before we transition the business, we want to make sure that those are buttoned up and taken care of. But the 2 that I feel like are the most important that, outside of any sort of glaring item that we may see with that client that we're working with, the 2 items that we like to address right away are the first 2. It's identifying the owner's exit objectives and goals, and then quantifying their business and personal financial resources. So let's kind of hop in and talk about those a little bit more. Now, most owners, when you kind of sit down and you ask them, what are some of the goals or objectives that you want to have when you're going to transition out of your business? And they might think about, how much longer do I want to work? Who do I want to transition that business down to? What do I need from an annual after-tax income perspective? Or how much do I want to have so I can have the retirement that I want to going forward? And these may be easy questions for them to answer. They may want to work, 2 more years, 5 more years. They may have wished that they had transitioned out 2 years ago. They may have an idea of who they want to transition the business down to. If it's first generation and second generations in the business, they may think that those are the individuals that they want to see take over. Maybe there's a key employee that's been with you for quite some time that you want to have a little bit of a stake in ownership. Maybe an ESOP, an employee stock ownership plan, might be a good option that's there. Or maybe you're just deciding, at the end of the day, I'm just going to try to take this thing to market. That's who we're going to go for. We're going to put it out in the market, sell it to an outside third party, and see what sort of value we can get at the end of the day. But a little caveat to kind of note there, if you are going to look to go to that outside third party route, roughly kind of 20 to 30% of the companies that are actually put on the market actually sell. So if that's sort of the fallback that an owner has is, oh, I can just put it out on the market, there's going to be somebody that wants to buy my business. That may be harder than they anticipate finding that right buyer. That right buyer might be the right circumstances, the right dollar amount. There might be a lot of factors that go into finding that right buyer. But if you think like, hey, I can just put it out on the market, we should be good. Some of those owners may be a bit surprised by the lack of activity that they may see. Now, besides these three questions, which are kind of first and foremost the ones we like to kind of get an idea around, oftentimes there's a lot of non-financial or value-based objectives that these owners are thinking about. It could be family harmony. You may have multiple children, but only a few of them actually work in the business. And you could see where if you transitioned ownership down to those few children, how your children who aren't involved in the business, may not necessarily agree with that or may have some issues with that. So there could be some family disconnect that's there. So that owner may decide, hey, at the end of the day, to keep my family, keep my family harmony there, keep everybody together, I'm just going to sell it to somebody else and not keep what's inside the family. The exact opposite could be that this could be a legacy thing. You could be second, third generation owner, and you want to be able to keep on that legacy that the prior generations were able to build, to grow and build upon. That you want to say, I want to keep this within the family or keep this within the business and find ways to continue to grow that. One that we find is often very important is maintaining the culture, especially if they're looking to do any sort of sale to an outside third party. You may have a great thing going on with your business, with all of your employees. Everyone gets along really well. You just got a great culture. It's a place that a lot of people want to be and work at. That there could be some concern that if you would sell to that outside third party, that culture may change. There could be something that, there may be layoffs or who knows what the situation might be, but that culture piece can be very important to them. Community as well. If you're in a smaller community and one of the main employers that's there, if you really help and support the community, if you, again, have that sale to an outside third party, there could be jobs that might go away. They may not have the same community involvement that's going to be there. So there are often other reasons outside of just when do you want to retire, who do you want to transition it down to, and how much do you want to get for. There's a lot of other things that owners think about and care about when they're looking to transition and transfer this ownership interest at the end of the day. And so I feel like when we go through this process with our clients, that sort of this first step is identifying their exit goals and objectives can be the part that kind of takes them the longest. It takes a lot of reflection on their part to figure out what do they want to do, because they've been in the business for the last 20, 30, 40 years. What is that first day going to look like when they're no longer that business owner? So we want them to really kind of sit down and reflect on that, and working with them decide what do they want to do or what do they want to try to achieve, and then we can help try to put that in the best position possible. So we have our first polling question here. The question is having a transition strategy important? Yes, no, or not sure? All right. That's the result. We'd like to see everyone agree. Yeah, having a transition strategy is extremely important to, one, make sure that business is going to be successful in that transition, and two, to help make sure that we can take care of your family at the end of the day and take care of the people that you want to. So the second step or the second component of an exit and succession plan is we really want to help the owners get an understanding of what's their business worth and understanding where their personal financial resources are. And kind of what do we mean by that is, if at the end of the day, going through that first step, as we say, I need $3 million after tax to be able to have the retirement that I want to have going forward. Okay, great. So we're trying to get an idea of, we need to get to roughly $3 million after tax to be able to have the retirement that you want to have. Well, what if the business is only currently worth $2 million? We want to, and then we've got a bit of a gap that's going to be there. So if it's $2 million pre-tax on a business value side, but we know from a personal financial resource perspective that we need $3 million after tax, we've got a gap that's there. And then the question starts to become, all right, how do we bridge that gap? How do we either ideally get that business value up, that at the end of the day, when we make that transition, we're going to have the personal financial resources available to us that we can have that retirement that we want to have. ideally, if we can help it, we don't want to have to hopefully lower those personal financial goals that you want to have in retirement, the things that you want to do, travel, the goals that you want to accomplish after you transition that business. But having this snapshot is very important to kind of see, all right, where do we currently stand versus value that we've got versus what do we think we need at the end of the day? And this is where, working with financial planners, the other financial advisors that you have, we can run some of these cash flows to see what do you need to have today to leave the business to be able to have the spending power that you want to for the next 20, 30 years into retirement. And then we can kind of go back to see like, all right, well, what's the business currently worth to help estimate what that cash flow is going to be, so we can try to sync these two up as much as we possibly can. So everyone may kind of have that water cooler idea, talking with some other friends or other owners about what their business might be worth. But we would want to take the time to potentially look at getting a business valuation to see what is my business currently worth. And that's going to help us to look at what sort of gap might we have between business value and personal financial resources to make sure that we can help you get to the point that you can have that retirement that you're going to want to have at the end of the day. So we highlight here, we won't go into these in a lot of great details, but what are some of the important reasons for having a business valuation? Well, if you decide to take it to market, most sophisticated buyers are going to require one. So if somebody comes along and they're going to offer you $10 million for your business, but you're not really quite sure what your business is worth, that $10 million may be a low offer. That may be something that, or maybe an offer that you never dreamed that you could actually get at the end of the day. So having that valuation helps you to have an idea that as offers come in, that if that offer is going to be, completely lower, that you wouldn't accept it, or something that was twice the value that you thought it might be, and it's something that you just pull the trigger on immediately. So having an idea, an actual valuation of what your business is worth can be very important. And business value is relative. It's not fixed. So there could be a lot of things that market conditions, if you've got, a couple, lean years that might be there, that the cash flow isn't coming in as consistently as it previously had been, that you could see that business value dip a little bit. So having an idea, knowing where it's at, and we'll discuss in a little bit what are some of the drivers that we can do to help maybe increase that business value to get you to that point that you want to be at the end of the day. We need to have that starting point to really help us continue that process going forward. A couple other reasons that we have here, growing the value of the business is important. Like we mentioned, it's important to keep key management, key employees motivated. So if we've got certain benchmarks or goals that we're trying to hit, knowing what's going to help get us there, the benefit if we reach these goals and benchmarks, what that impact's going to be to our business value at the end of the day. Having that understanding helps to make those goals attainable or achievable, or something that's tangible that people can go after and try to get. And if you're going to transfer to a key employee, would you accept an unsupported value? If you're going to go to somebody and say, hey, I'll sell this to you for $1.5 million, that key employee may not have any idea if that business is actually worth $1.5 million. Could it support $1.5 million payment back to the owner if they're using company profits to buy that interest? So it just kind of helps to have overall a good sense about what a value might be. And then the last item that's there are these valuation discounts, and Ramona might talk about this a little bit later, but from an estate planning perspective, there could be some benefits of having that valuation because of the interests that are being transferred, that we could take certain discounts, minority discounts that might be there to help minimize the amount of estate tax that we might use, or our estate tax exemption that we might use in transitioning a business down to, say, our children, or if you wanted to gift it to a key employee or whatever that situation might be, that these valuation discounts can come in pretty handy and be pretty powerful at the end of the day. So when we have an idea about what our business value might be, and kind of going back to that second component where we talk about if we've got a gap between our business value and what we need at the end of the day from a personal financial resource perspective to walk away, then we start looking, and we know that business value is short, then we start looking at these value drivers. What are some of the things that we can do to help increase the value of our business? If you're going to an outside third party, do you have some of these processes, procedures in place? Do you have a strong management team that's going to be there? That, they're the ones that kind of are running the day-to-day operations of the business as a new owner comes in, or if it's a private equity or whoever it might be, they know they've got that strong management team that's going to be there to continue the business moving forward. You know, looking at your operating systems, looking at an established and diversified customer base. You know, if looking at that customer base, if an outside third party is coming in and they see that you've got, you know, 70% of your sales come from you know, 10% of your customer base, if that owner who's exiting has a really great relationship with those customers, and they're not, maybe not overly excited about, or there isn't a smooth transition to that new owner, and those customers go somewhere else, that's going to be detrimental to that new owner that's coming in, and they may not be willing to pay as much for that business, or may not find as much value at the end of the day. A couple more items here. You know, it may sound silly, but facility appearance, you know, especially if you're going to go to an outside third party that's coming in, they want to kind of see, you know, how are the facilities run? If you've got a plant, if you've got a manufacturing facility that's there, you know, how clean is it? How smooth are the operations? And a lot of business owners take pride in that respect. They take pride in having those nice, clean facilities. You know, do you have realistic growth strategies? Do you have effective financial controls? And then obviously cash is king, so they're going to look at to see, do you have stable and increasing cash flow? Now, if you have some of these things that are going to be there, we can use these value drivers to help either increase the value of your business over time, if we've got a timeline before you're ready to transition, or if you're taking it to market, these may be ways to help get a premium from certain buyers if they see that you have some of these controls in place, or that you've got strong growth strategies and you've been hitting those benchmarks over the years and you've got strong cash flow. We may find that we get multiple buyers to the table, or we might get multiple, you know, might get a premium on that transaction. So there's a lot of things we can do to help try to increase that value. So we've kind of touched on it a little bit, but there's primarily two exit routes for most business owners. We either have an outside transfer to a third party, and like I mentioned, that could be a competitor, it could be private equity, it could be a bigger company within the business that just kind of merges you into their existing company. And when we have clients that are looking to go that route, the item there, if you decide to take the exit path where you're going to transition to an outside third party, what we're trying to do with that is maximize the business value that we can get and accelerate the payment of those proceeds. We want to try to get as much cash as we can and get that cash as quickly as possible. You know, there may be some holdouts or some earnouts that might be there, but we want to try to get as much of that cash flow up front as we possibly can. If you're going through or thinking about taking it to market, you know, we've got a lot of great relationships with private equity firms, investment brokers. We actually have a group within Eide Bailly that assists with that process of taking it to market and looking for potential buyers. And if that's a route that you're thinking of going, or if that's a route that you want to go, the earlier that you kind of get in touch with the private equity firms or the investment bankers, the earlier you can start to kind of assess, all right, what is the, you know, how well would our company look if we were going to take it to market? You know, are there some certain things we need to clean up on the financial statements? You know, what else do we need to do to put ourselves in the best position that when we actually takes time to go to market, that we're going to get some activity, that we hopefully get a couple offers to choose from, that we're not going to be, you know, just the 20 or 30% of the companies that actually sell on market, that we're going to have a lot of activity that's going to be there and can kind of have a choice or decision about who we want to sell it to. Now, there are a couple other options that are external as well. You know, it could be the point that you're going to take it IPO. You know, you may grow your business to the point that you're going to make that initial public offering that's going to be out there. The one that we really hope most owners don't do, and that's the whole point of why we're trying to do this planning, is the orderly liquidation. So at that point in time, you know, if there's an orderly liquidation, you may have come to the point that there is no buyer that's out there, or you don't have a key employee or family member that you want to transition the business down to. And we're sort of just taking the assets that are there inside of your existing business and we're liquidating them. And oftentimes, if owners have to go that route, we're not going to get nearly the value out of that liquidation that we could if there would have been some planning at the forefront that may have helped us to avoid that situation. So it's an option that's there, but hopefully it's the last resort that's going to be there for a lot of owners, because they likely don't get the value that they're looking for using that orderly liquidation at the end of the day. But there are certainly situations where that's sort of the only option that's available. Now, the second option that's there is a transfer to what we call to an inside, an internal party or an inside party. And that could be your co-owners. Maybe you're a 50-50 owner with somebody else and you want to just transition your ownership to them. It could be a key employee that's going to be there that might buy out some of your ownership. We touched on this earlier a little bit, but it could be an ESOP or an employee stock ownership plan where the employees essentially own the business that's going to be there. We've got a lot of clients that have used those ESOP transactions. Or maybe your goal is you just want to get it down to your children. And if that's the case, then we look at, all right, what's the best way to do that? Maybe we sell part of it to them. Maybe we gift part of it to them. And Ramona might touch on some of the gift strategies and ways that we can utilize some estate planning techniques to minimize the amount of estate tax exemption that we might use, but still get some of that ownership down to the children at the end of the day. So, going through with those exits, going back to that first component, we want the owners to really think about what is their goal at the end of the day? Who do they think they want to transition it down to? And the sooner that we start this process, the better off we're going to be, because if we have to make a change mid-planning stream and go from, all right, we thought we could take it to market, well, now there's a key employee that really wants it, or our children are now really interested, we've got the ability to make those changes and adjustments along the way. So the next component here is the business continuity planning. In my mind, kind of looking at this, it's the proverbial getting hit by the bus scenario. One of the biggest things that can be detrimental to the business is loss of key employees or loss of key talent. And why I think this is really important to me, because I watched my mother-in-law actually go through this, where she had a very successful auto dealership in central Minnesota. Was Entrepreneur of the Year a number of times in that area. And about 12 years ago, she was diagnosed with a rare form of dementia. They call it semantic dementia, but that's really not important. But kind of along the way, you could see that she was starting to change. And she had some really key people that were part of her dealership that had been there for 20 years. And they didn't understand some of the decisions that she was making or the changes that were going on, because nobody really knew what she had at the end of the day, or nobody really knew what she had at that point in time. So they became frustrated. They were really frustrated with the progression of the business going forward, how it sort of stalled out and everything. So they ended up leaving at the end of the day. And when time came that we finally got it diagnosed with what she had, we knew that we had ended up having to sell the business. Well, those key employees that likely would have been there, that would have probably been happy to take this on, were no longer there. And a business that was probably worth $2.5 to $3 million at the end of the day, at its peak, we ended up selling it for about $750,000, for about $750,000. And going back, looking at it, there was no business continuity planning that was there. We didn't have some of these safety nets that were going to be there, that if something happened, who was going to be the next person that was going to step up and really help make sure that the business continues on and continues moving forward. So not only is it detrimental to the business, but it can be detrimental to the family too, because you may now have lost that main source of income that's coming in for the family. So thinking about this just as much as the succession planning it needs to be an important component of that succession plan at the end of the day. And then the last item here, which I think Ramona will touch on a little bit, but is the personal wealth and estate planning. So what we want to have at the end of the day with your estate planning documents, with your personal financial planning, with your business succession planning, we want to make sure that they all sync up and that they're all talking to one another. So if we know that you've got 4 children, but you plan to transition the business down to 2 of them, and that's in your business succession plan, well, that's great. But we want to make sure that your estate planning documents say the exact same thing. If your estate planning documents say that business interest is going to go equally to all 4 children, there's going to be likely some issues that are going to come up at the end of the day, where the children that thought they were going to get 100%, now they've got their siblings who haven't been involved in the business. Now they're currently a part of it, and there's just going to be a lot of disconnect that's going to be there at the end of the day. So we want to make sure, as we're going through this process, that we're making sure we're making all these adjustments that are along the way. And it can seem like a daunting task, but we can really take it in sections. We can take it in parts, making sure that we've got everything set up with the succession plan, or we need to maybe update the estate planning documents first. But at the end of the day, working with the advisors that are going to be part of the team, that we're all on the same page and that everything is syncing up and saying the same thing, that's the ultimate goal that we're trying to get to at the end of the day. So I like this quote. It's, succession in a closely held business is never just about succession. If you're trying to transition it down to children, there could just be a lot of disconnect that's there. The kids may not get along. There could be a lot of underlying, those value-based objectives that are going to be there. It may not be just about a dollar amount at the end of the day. There could be a lot of other things that owners of a closely held business want to make sure that they accomplish at the end of the day. So it's never just about, if you kind of come in thinking like, oh, I can just easily transition this down to key employee, children, or I can take it to market, we may have already sort of lost that battle before it even started, because there's a lot more involved to this overall succession planning process than just that. We've got our second polling question here. Question number 2 is, growing the value of the business is important, true or false? All right. So a couple of things that help making this transition as successful as possible. One of the first things that we think is important, everyone really focuses on the value that's there at the end of the day, but acknowledging and dealing with the changes and emotions that are involved, whether it's from the owner's perspective. Like I mentioned, if you've been that owner and been running that business for 20, 30, 40 years, that's been a big chunk of your life. That's been a big commitment that you've had to either starting, developing, and growing that business into what it is today, that it's going to be a pretty emotional process when the day comes that you're no longer that owner. How are you going to handle that? What are some of the things that we kind of need to deal with along the way? We need to continue to put the interest of the business first. This can be a fairly long process, and as we sort of take it, piecemeal at a time, but we need to make sure that we're not losing sight of what the business is trying to do. Making sure that the growth is still there, that the cash flow is still there. Allowing sufficient time for this process to evolve. We had the survey that showed we have a lot of owners that want to try to get out in the next 5 years, over 50%. And that's great. I mean, ideally, we'd like to try to have, at least 3 to 5 years, 5 to 10 would be great to kind of work through this process, because what it does is allows us to help create a framework around the overall succession planning process and what you want to achieve, and allows us to be able to make adjustments along the way as certain things and certain items come up. And like we talked, the emotions can be very important here, and why owners avoid this oftentimes. There may be unpleasant management issues. If you got key employees that have been there kind of with you from the start, but they may not be part of that next group of owners, that may not sit very well with them, or they may not have had the chance to share who they think might be the right person to do that. The thing that I find interesting is owners going through this process fear that their options are going to be reduced. They're not going to have as many options in front of them by going through the succession planning process. And I think it's the exact opposite. The more time that we have, the more that we go through this process, it really allows us to kind of lay everything out on the table, and we can really see what are all of our options. And at the end of the day, which one's going to make the most sense for me and my family and for my business to find that right person that you want to transition it down to at the end of the day. So the last item here that I'll leave you with before I'll turn it over to Ramona is talking about the chances of the business being successful 15 years after the succession or the transition has been made. If we've been planning for 10 plus years, working on that succession plan, so we've kind of been grooming that next generation of leaders, or finding the next person who is going to be stepping into that control, 85% of those businesses were still in business 15 years later. And you can see, if we kind of just have that 2 to 10 year window for the amount of planning, half of those businesses that had done that succession planning were still in business 15 years later. And you can see that if it's 2 years or less, and if you go back to some of the slides from earlier, as far as when do owners want to get out, there's about 20% that want to get out in the next 1 to 2 years. Well, there's a 25% chance, if that's the case, and those owners aren't really doing a whole lot of succession planning, there's a 25% chance that business is still going to be around 15 years later. So it just really highlights what I think is a good point, that the more time that we have, the more options that are on the table, and the better we can really help position these owners to make this transition as successful as it possibly can be. So with that, I'm going to turn it over to Ramona and let her talk a little more about the estate tax and planning implications.
Thanks, Derek. So Derek gave you a lot of reasons to work on succession planning for your business, from a from a business standpoint, and there's a lot of other things that need to be considered as you're looking at that transition. One of them is the estate planning part of it, because as Derek indicated, you want your estate plan to be consistent with what you're doing from a succession planning standpoint, just because things happen, and if something should happen to you as the business owner, before that transition is complete, you want to make sure that it's completed in the manner that you want. So as I said, one of the considerations is the estate tax, and we have had some significant changes in that area in the past couple years. The 2017 tax reform legislation did significantly increase the exemption, or basically the value of property that you can transfer to family members or other individuals without incurring an estate tax liability. So for federal tax purposes, the exemption was increased to the increase for this year, 2019. The exemption is $11.4 million per person. So that means a couple can transfer $22 million to children, grandchildren, etc., without paying any estate tax. The tax rate itself did not change. It's still at 40%. So once you go over that $11.4 million exemption number, then 40 cents of every dollar over is your estate tax liability. The exemption is the same, $11.4 million for estate tax, gift tax, and generation skipping tax purposes. A question I get fairly often is, okay, how does the different exemptions, how does the different types of tax apply with the exemption? And the gift tax and estate tax exemption are cumulative. So you only have one $11.4 million exemption. You can either use it during your lifetime or at death. So if you use 10 million of it during your lifetime, then you only have $1 million available at the time of your death. The generation skipping tax is a little bit different. That's a tax that's applied when you are transferring assets to or for the benefit of grandchildren, the most common example. Those assets may benefit your children, but they're not going to be included in your children's estate for estate tax purposes. There's a limit on that of the 11 million also, and that isn't always tied, or you're not always using the GST exemption when you're using the gift or the estate tax exemption. So they're two separate exemptions, but they can be applied differently. The one other thing that did not change is portability, and we'll talk about that in a minute, but that really was a game changer back in 2011, which really changed how we look at estate planning. So we'll talk about that in a minute. The one thing that makes planning right now very difficult is the fact that the increased exemption to 11 million is not permanent. Under current law, that exemption falls back to what it would have been under old law in 2026. The estimates that I've heard is that the exemption could be in the $6 million range because there is an inflation adjustment every year. So we have the $11 million exemption now and potentially a $6 million exemption in 2026. Again, that's the way the law is written. So Congress needs to do something in order to extend the $11 million exemption past 2026. The other thing to consider is that Congress could do something before that time to change the exemption. So for example, if there's a change in party in the White House or the Senate, the House, you know, that change could happen sooner than later. The other change that happened last year is we finally did have an increase in the annual exclusion to $15,000 per person. So as I mentioned, we do have this possibility of what we call sunset in 2026. And we've also heard comments that, well, I want to use my extra exemption, and so I want to gift that $6 million, $5 million. And the problem with it is that in order to use the higher exemption that may go away, you need to gift the entire exemption, the full $11 million. So that's just something that you need to consider. The one question that we initially had was, what happens if I use my $11 million exemption? During my lifetime, I use it through gifts, and then I die when the exemption is $6 million. Is that difference of $5 million subject to estate tax? And that wasn't addressed in the legislation, but the IRS has issued some proposed regulations that indicate that that will not apply. This is what we call clawback. But that $5 million that you gave away is not going to be subject to estate tax. So hopefully that holds true as we move forward. Now, one thing to consider with the estate tax is that there's a few states out there that do still have an estate tax at the lower exemption amount. The ones that we deal with through our Eide Bailly offices are Minnesota. I deal with Minnesota a lot, being in Fargo. And then Oregon and Washington both have an estate tax. In Minnesota, the exemption today is $2.7 million. So you can see there's a significant difference between the state exemption and the federal exemption. And we have a polling question. So what is the estate tax rate that we currently have? 50, 45, 40, or 35%? And the correct answer is 40%, so the majority of you got that right. And again, that's basically a flat tax once you get over the exemption amount. The next thing we're going to talk about is portability. And as I said, this was a real game changer a few years ago. In the past, if you wanted to use, let's say for a married couple, if you want to use both spouses' exemption, you needed to plan for that, because if the exemption was not used on the first spouse's death, it was lost. What portability has done is given us the ability to carry over that unused exemption from the first spouse to the second spouse. There's a lot of rules that go along with that, but it has been a game changer. And one of the things that has really changed is that in the past, when we were looking at a potential estate tax liability, that was always the primary focus, because the estate tax rate was higher. Again, we needed to be sure to use the first spouse's exemption. So now that we can have more flexibility by having that federal exemption carry over to the surviving spouse, the income tax consequences have become a much bigger consideration. So do we want to use the exemption on the first death, which may be beneficial if you have a highly appreciating asset? It may be beneficial to use that exemption. Or do we want a chance for a step up in basis at the time of the first death, and then again at the second death? Now, just briefly, in case you're not familiar with step up in basis, what that is that if you die owning an asset, the basis, the cost basis in that asset is stepped up to fair market value as of your date of death. For most assets, there are a few exceptions. So again, if there's going to be appreciation between the first spouse's death and the second spouse's death, do you want that benefit of that step up in basis? And that's where portability can really come into play. Some of the advantages are simplicity. You may not need the complicated estate planning documents that you've had before. And really it gives us a lot of flexibility in that we can, if the plan is drafted appropriately, we can make decisions on estate tax versus income tax at the time of that first spouse's death. Some of the risks or disadvantages is, one, you do need to file an estate tax return. Even if that first spouse had no or little property, you still have to file a return in order to make the election. That unused exemption amount does not get adjusted for inflation, which may or may not be an issue. It's not, the generation skipping tax exemption is not portable, so if you're doing planning for grandchildren, you really need to consider that. And then no states have really adopted portability. So for us dealing with Minnesota, if we're wanting to use the Minnesota exemption, we need to plan for that, and you're going to need to have assets that aren't going directly to a spouse in order to use the Minnesota exemption. This has really changed some of the things in how the documents are laid out. And I like pictures. Pictures help me explain things or understand things. So in the past, we have a lot of documents out there that automatically fund what I've got labeled as the disclaimer family trust. So when we were needing to use each spouse's exemption, that family trust got funded with whatever that federal exemption was. And then everything else went to the surviving spouse or to a trust for the surviving spouse. Well, now with portability, we don't maybe need to automatically fund that family trust, but you may want those provisions to be included in your will just in case you're wanting to use that family trust concept. The surviving spouse can be the beneficiary of that trust, but that spouse will not own that trust for estate, may or may not own that trust for estate tax purposes. One of the ways of doing that is a disclaimer. It's a action taken by the surviving spouse to say, whoa, I don't want some of these assets, I want them to go into the family trust. An example of that might be a Minnesota resident wanting to use the Minnesota exemption. They're going to push, $2.5 million into that family trust. The other way of doing it is to fund the family trust according to the terms of the will, but it's set up so that at the time of the first death, you decide whether you want those assets included in the surviving spouse's estate or you don't. And again, that becomes an income tax question more than an estate tax question. Now you'll see that I've got children, receiving the assets, and especially with closely held business owners, the one thing I'd point out is sometimes how your children receive their inheritance or who receives the inheritance can be the most difficult decision. Especially if you have children in the business and children out of the business. Derek kind of alluded to that earlier. And there are things that you can do to give the business children more control where non-business children may own assets. We have a lot of cases where the children in the business are receiving more than the other children. And just know that you're needing to decide the fair distribution of assets. It doesn't necessarily mean that it's always equal between your children. For those of you that have done planning in the past when the exemption was lower, even lower than the $5 million, there might be some situations where you want to undo or take action to make sure that you're maximizing the step up in basis, especially if you're not going to be subject to estate tax any longer with these higher exemptions. Some of the things that we look at, and again, it's weighing the income tax and the estate tax. Some of the things that we look at is revising documents or unwinding things so that you can maximize the step up versus maximizing the discounts. So let's say you owned your company, the husband owned the company 100%, and because of the estate tax, you split that ownership, so it's now 50-50 for each spouse. Well, because it's 50-50, the reason for doing that was to take advantage of these discounts. If you're not subject to estate tax anymore, do you really want those discounts? So maybe you look at changing that ownership structure again to get the step up that you want. Maybe there's like partnership agreements that were structured to maximize discounts that you may want to update, make changes to, so that you're not maximizing the discounts, you're minimizing them. There's also potentially things that can be done for trusts, old trusts, that wouldn't have step up in basis in order to get that step up. We've had a number of questions relating to life insurance that was purchased for estate tax, for paying the estate tax. And should we get rid of that? Can we get rid of the life insurance or the life insurance trust that owns it? And a couple of cautions. Well, one, the life insurance trust, the ILIT as we call it, is structured so that the estate tax or the insurance is owned outside of the estate, and you're not paying estate tax on the funds that you're wanting to use to pay the estate tax. So that's the purpose of the ILIT. The things to consider are, one, remember that the exemption may go down. So you may not be subject to estate tax with an $11 million exemption, but will you be subject to estate tax with a $6 million exemption? So remember that there's that possibility. The other thing, if the insurance is owned in the trust, you do need to consider what the terms of the trust agreement are, because they may be structured in a manner that there's work that needs to be done in order to liquidate that insurance, or liquidate that trust rather. Here's a list of a few things that you could do to again use the additional exemption. If you are subject to an estate tax liability with the higher exemption and you want to use it just in case it goes down, these are some of the things that you could do to look at that. So here's the fourth polling question.
All right, that fourth polling question is now open. Which statement below can be considered a portability risk?
Yeah, the statement that is a portability risk is that the generation skipping exemption is not portable. So if you're wanting to use that, maximize the use of it, then you need to use that at each death. So since as part of the succession planning for a business, you may be looking at transferring ownership of the business during your lifetime to family members. And so I want to talk a few minutes, we're almost out of time here, but talk for just a couple minutes on what some of the options are and the considerations for doing that transfer. If you are looking at doing it during your lifetime, again, keep in mind that assets that are gifted during lifetime do not receive a step up in basis. So let's say that you have your company, you want to do some gifting or give some value to your children now, but you anticipate that the business will be sold at some point in time after you're out of the business or after your death. So then what's more important, getting the assets to the kids now without that step up in basis, or are you better off having that step up in basis? That would be something to consider. Again, making sure that your will or your revocable trust are consistent with what you're doing. So we've had situations where mom and dad have given the business or part of the business to the business child during lifetime, and then they have a provision in their will that there's some distribution to the other children before that business child receives anything. It may not be the same value, but there's something to make sure that the kids get to that fair allocation. When we're looking at it, if you have a potential estate tax liability, some of the things that we look at first are, you know, life insurance. Again, if you own life insurance, you're paying estate tax on it. So you want to structure it so you're not paying tax on it. Maximizing discounts. Again, we talked about in some cases you may be wanting to minimize discounts, but if you are going to be subject to estate tax, you want to maximize discounts. So is there ownership structure, you know, other things to do that. And then again, if you want to leverage, you know, make transfers, take advantage of the higher exemption, there are things that we can do. There's, you know, making gifts and just doing outright use of the exemption amount. Or you can use the trust that I've identified here, the grantor retained annuity trust, and a sale to a grantor trust. And there's information that I'm not really going to have time to go over, but the thing to consider is that these are ways of transferring stock to the next generation without using a lot of your lifetime exemptions. So you're preserving that for assets that you own at death that can have the step up in basis. There are techniques where you are transferring assets in exchange for some cash flow. So if you're needing cash for retirement, this might be a way of doing it. The thing to consider is that with both of these techniques, you are paying, the person that's creating these trusts is paying the income tax associated with the entity that's in those trusts. So you're getting cash, but if the cash is covering that income tax liability, you may or may not have any actual cash left in your pocket for living expenses or other things. So when we're setting these up, we really look at the cash flow that you need in order to make sure that they make sense from a financial planning standpoint. And that's something that will probably be covered in next month when you have a financial planning webcast as part of this series. With that, here are a couple flow charts that illustrate these techniques, and basically it's either a transfer to a trust in an exchange for an annuity, or it's a part gift and part sale transfer to the trust in exchange for a note. And these two, this slide and the next slide, show the pros and cons or advantages, disadvantages of each of these techniques. And if you have any questions on any of this, do feel free to reach out to me, since we didn't get a lot of time to talk about it. But to wrap up, couple things just as a reminder. Just remember that we do have the $11 million exemption today. That doesn't mean we have it forever, because under current law it is scheduled to sunset or go back to possibly $6 million in 2026. And because of that high exemption and portability, we do want to leave the planning documents as flexible as possible, so decisions can be made at the time of that first death rather than something set that's not really changeable later. So again, flexibility has become a big key. I'd like to thank all of you for attending our webinar today. And again, if you do have any questions, please reach out to Derek or myself, and we would be happy to answer them. And I hope you have a great rest of the day.
Awesome. Thank you all so much.